So we've been talking a lot today about how scientists are predicting there's going to be changes in the frequency, the magnitude, the timing, the duration, the spatial extent of extreme events as the planet warms. So in my few minutes, I'm going to go through 3 arguments on what I think the role of insurance is in helping us adapt to those changes. Let's see if this works. Yeah. So my first point is a positive one. I think that insurance is going to be an increasingly important adaptation tool in helping us deal with these extreme events. We know that disaster costs have been increasing steadily over the last several decades. A lot of that is driven by where and how we build, but there's starting to be a climate signal and loss data, and climate scientists tell us that's only going to get worse. And of course, we know 2017 set records for hurricanes, flooding, and wildfires. And insurance is really important for providing resilience for households and communities against these type of events. And why? It's because insurance provides larger and faster payouts to people than almost any other type of post-disaster assistance. For example, we've done work at the Risk Center showing that federal disaster aid takes months and months to get to victims often, and it's quite limited. It's much less than most people assume that it is. And so in order to really rebuild, you have to have insurance. And there's been research showing that when people are insured, they have a much greater likelihood of rebuilding, that it limits the negative economic shocks to the household because then they don't have to draw down savings or divert current consumption or take on debt in order to finance their repairs and rebuilding. And it can also limit the negative multiplier effects that can happen in communities when households and businesses don't have the resources they need to get back online quickly. So insurance is necessary to protect people in the face of extreme events. But, and now I have a cautionary point, insurance on its own is limited. And risk-based pricing isn't going to solve all our climate adaptation problems. And I say that because I've heard many economists make the point that if we have prices that reflect risk, which is something we at the Risk Center firmly believe in, I want to say at the outset, but that would incentivize homeowners to undertake the necessary hazard mitigation. It would create incentives about where we shouldn't potentially be building in the face of these changes, and it would essentially lead to smooth and efficient climate adaptation. I want to say that unfortunately it is not that simple, and insurance can't play that optimistic of a role. And I'll tell you why. There's 3 problems. First, in order for insurance to work as an incentive tool, people have to actually purchase the insurance, and nobody buys disaster insurance. So what you see up here are take-up rates for flood insurance around the country, and very few people at risk of flooding currently have flood insurance. And I know we're talking about climate change, but earthquakes in California are very similar. Only about 12% of households in California are insured against earthquakes. Part of this is because, as we shall see, disaster insurance is often expensive, and for good reason, but when it costs too much, people drop their insurance. So if no one's buying insurance at risk-based prices, have we done anything to better manage our risk? And of course, it's really the counterfactual that matters there. But if we really want to use insurance as an incentive tool, we might have to mandate it. And that raises a host of equity concerns. And we've been doing some work in the Risk Center on how you could design programs to help low and middle income families afford disaster insurance. Another concern with risk-based pricing, and indeed in putting all the costs of disaster risk onto households, is in areas where risk is very highly correlated with amenities. So think about the hurricane-prone coast. If households bear the full cost of all that risk, it dramatically increases the cost of living on the coast, leading to coastal gentrification and possibly locking lower-income families out of that type of amenity. So it raises these challenges that we have to deal with as a society. Second, retrofits are expensive. Some are cheaper than others. Elevating your home, like you see here, can be anywhere from tens of thousands of dollars to over $100,000. And even if the benefits are worth it, and even if there's a positive payback period over a term that you're willing to consider, you have to have that capital up front. The government pays a lot for mitigation, particularly in these post-disaster supplementals like we've seen after the 2017 events. But as the climate warms, we're going to be facing this growing hazard mitigation gap in this country, and the federal government just can't foot the bill for all of it. There's just too much that needs to be done. So a lot of innovative financing mechanisms are starting to be developed and piloted, types of loans tied to insurance and these types of things, and Howard's done some work on this too. But even if those financing mechanisms are in place, there's a whole host of other challenges with getting households to adopt retrofits. They have to find the contractor. They have to get a price. They have to be displaced. They have to think about it out of all the other things they're having to think about every single day. And it gets back to the biases that Howard was talking about as well. People don't like to think about this stuff on a sunny day. And third, insurance is a one-year contract. So it's pricing and giving you a risk signal for your risks in this year, today, as it should, right? But if we want people to be thinking about how risks are changing, we need to complement it with other policy tools. Because when we're thinking about where we're going to site infrastructure or invest in assets that will be around for decades, we need to think about the risk not just today, but where it's going. And so we need to have other policy tools to communicate that risk, which is not well communicated to anyone at the moment. So yes, just to sum up this little part here, risk-based insurance will better align incentives. It's a very important policy goal. But for climate adaptation, it needs to be supported with zoning, with building codes, with policies to promote take-up of disaster insurance, with assistance for low-income families, with ways to communicate changing risk. All of that complicates the policy response, so it feels a little daunting, but it is clear that insurance prices alone are not going to protect us against these disasters. But now I want to circle back and end on a positive note. Building on the first point, as these extreme events change, insurance is going to become ever more critical for households. And yet that same change in extreme events is what's going to make providing that insurance increasingly challenging. And we're already seeing that governments have intervened in disaster insurance markets across every peril, not just in the US, but around the world. And so what we need to think about now is a public-private partnership that can help provide risk transfer when that's appropriate and also invest in risk reduction when that is necessary. I don't have time to go through this now. This is your textbook list of what makes a risk insurable. The point I want to make is that climate change is starting to undermine every single one of those criteria. So we're finding places now where flooding's not random. It's happening all the time. Sunny day flooding, nuisance flooding. Disaster damages are notoriously fat-tailed, and lines of business become correlated in an extreme event. So that dependency is clustering in the tails, which makes it a very costly product to offer. We have challenges with the way we've divided insurance in this country across perils with determining what the losses are after a fact with our indemnity-based model. Was it wind? Was it water? There's lots of lawsuits on this. These markets are characterized by adverse selection. And what you end up finding after many extreme events is a breakdown in disaster insurance markets, where there might not be a price at which the private sector can profitably offer coverage that's a price that people are willing and able to pay for. And indeed, in response to perceived lack of availability or lack of affordability in disaster insurance markets, governments have intervened across every peril. And so just by way of analogy, not just the weather-related climate disasters, but looking at all kind of catastrophic perils, we have federal programs for terrorism, we have federal programs for flood, we have state programs for earthquake, for hurricane wind across every state that's exposed to hurricanes along the Gulf and the East Coast. And there are similar programs that are structured a little bit differently in all the major developed countries across the world. There is not currently anywhere a fully healthy, functioning private sector disaster insurance market without any government support at all. Insurability, however, is a spectrum from the easy to insure to the hard to insure, and there's lots of things that can be done to make risks more insurable. Some of this is on the side of the policy, selective underwriting, the structure of the policy. Some of this has to do with broader diversification, reinsurance, putting risk into the financial markets. But it also has to do with risk reduction. When we invest in risk reduction, we make risks more insurable. So I want to end on an optimistic note that builds on some work that Howard and I did comparing the way all these government programs are structured and how the way those are structured can influence outcomes that we care about. And we've put together this model where you kind of layer insurance in a way that addresses moral hazard at the individual, that addresses the problem of the long tail of disaster damages at the top of your distribution, and is supported by both public and private sector activities for risk communication and risk reduction. And I think if we move in this direction, we can really harness the power of insurance for climate adaptation.